You're listening to the Money Hour with Mitchell and Mercer. Now, in the studio, local mortgage and finance experts Tina Mitchell and Mike Mercer.
Welcome to the Money Hour with Mitchell and Mercer, the Sunday, January 27 show. I'm Tina Mitchell, Mortgage Diva, and sitting to my left is my co-host, the Mortgage Master, Mike Mercer.
Hi, Tina. How are you?
I'm doing good. How are you today?
Doing very good.
And we're here to talk about money today every Sunday at 2 p.m. We're dedicated to our listeners, providing you with the tools needed to make informed decisions on matters that affect your money. You can reach us at 1-888-987-0570 or online at themoneyhour.com. Mike, who do we have in studio today?
Well, we have a couple great people. We have Rich Keal, who is with Generational Wealth Advisors, and he also has with him Hanna Haage. And Hanna is originally from Europe. She's bringing part of what they call it German engineering financial tactics that we're going to listen about. And
boy, that sounds exciting.
Doesn't that sound good?
Yeah.
When it comes to wealth management. And then, of course, we also have Angela Hardy with Prudential Real Estate.
Sounds like it's time for some money chat, Mike. What do you got for our listeners today?
Well, this is an article I stumbled across in MSN Money, and it says 10 ways. I thought it'd be applicable for today because it says 10 ways to get ready for retirement in 2013. So I thought, because of the nature of some of our guests that we have in studio, this might be a good article to talk about. But all right, 10 ways to get ready for retirement in 2013. Number one, the article said, try to save 1% more. So it can be, a little intimidating to focus on a bigger number, such as like trying to save $1 million in retirement savings. But instead, the author of the article suggested try to save 1% more than you did just the previous year. Also consider allocating a portion of any raises or bonuses that you might receive to that retirement account. Number two, max out your employer benefits. So basically, get your employer to pay part of your retirement by signing up for, your workplace retirement plan and or contributing enough to get a 401k match. If you earn, $50,000 a year or more, and you can get a 3% employer match, you could get an extra $1,500 for retirement annually. Number three, make use of new 401k fee information. So basically, take a look at your new quarterly and annual 401k statements to see what fees are being deducted from your 401k. And if your funds are not, delivering enough value to be worth the cost, they say definitely consider switching to investments with lower fees. Number four, claim retirement savings tax breaks. So you can defer taxes on up to $17,500 in a 401k and $5,500 in an IRA in 2013, which basically jumps to $23,000 in a 401k and $6,500 in an IRA for those age 50 and older. Low-income workers who save in retirement accounts may also be able to claim under the Savers tax credit. Number five, diversify with a Roth. Consider doing some of your retirement savings in an after-tax Roth account, which will generally give you easier access to your money before retirement, more withdrawal flexibility, and a smaller tax bill in retirement. Now, again, let's just make sure that, Tina, you and I are not suggesting that anybody do any of these things. And of course, some of our guests might have some different opinions about what we're going over. But again, this is just an article that I thought would be interesting for discussion purposes.
I like that, Mike, discussion purposes.
Yeah, discussion purposes.
Hypothetical.
Yes, I can see Rich and Hannah kind of just like, their eyeballs are rolling. Number six, get your Social Security statement. Workers age 18 and older can now access their Social Security statements online. Take a few minutes to check what your earnings history has been and make sure that's been properly recorded, and familiarize yourself with what your expected Social Security payout is going to be. Number seven, run your numbers. We talk about this all the time. Run your numbers. Calculate how much you need to save for retirement. This is the only way to know if you're saving enough, obviously, to finance your current lifestyle over the next 25 to 30 years. We would obviously recommend, when it comes to running your numbers, to probably sit down and meet with somebody that knows more about it than maybe you do. So sit down with a financial planner, sit down with a wealth management team, sit down with somebody to help you kind of figure that out. Number 8, make a 2012 IRA contribution. So, while 2013 is too late, obviously, to make your 2012 401k contributions, there's still time to make a 2012 IRA contribution. That will save you money on your current tax bill. Investors have up till April 15th of 2013 to make 2012 IRA contributions. Number 9, and this is the one that everybody says ouch to, downsize your lifestyle. Well, who the heck wants to do that? That's not any fun.
Well, but if you look at the money you're not going to have when you retire, maybe it'll make it a little bit easier.
It might make it a little
That's why it's all about planning, right?
Right.
Looking at the numbers.
It might light that fire. So downsize your lifestyle. You'll be able to get by with, you'll be able to get by with a smaller nest egg, right? If you look for ways to cut costs before and after retirement. You might be able to do this by downsizing to a smaller house or a condo. Obviously, Tina, you and I see a lot of that happening right now.
Mm-hmm.
Once your children move out, moving to an area with a lower cost living, or selling a second car that you won't necessarily need in retirement. So just kind of things to think about. And then number 10, I thought this was really good. Decide on how you're going to spend your time. So once you do retire, map out what does your days look like. What are you going to be doing during the day, weekend? Are there trips, travel? What is it that you're going to want to be doing? So you actually can plan ahead to know what that's going to cost. Once your retirement finances are in place, you'll also need a plan for how to fill your days of retirement in. Take some time to dream about travel plans, a second career, or relaxing, on a stretch of beach somewhere. If you save enough, then you'll be able to really enjoy your retirement, and it will become a real reality for you. And then last, I was going to say you might also want to click on, if you're thinking about retirement soon, Google U.S. News, /money retirement, and they had some good articles in there. For example, the best places to retire in the U.S.
What were those?
For under $40,000 a year in retirement income. Well, I'm glad you asked. The best places
I'm gonna make
are
note of this.
Albuquerque, New Mexico,
Wow.
Augusta, Georgia,
No.
South Carolina,
No.
Jackson, Mississippi, Knoxville, Tennessee, Little Rock, Arkansas, Louisville, Kentucky, Pittsburgh, no thank you, St. Louis, and San Antonio. So out of all those, I think I would
New
look
Mexico,
at
San Antonio.
Exactly, the first
St.
and the
Louis.
last. Yeah.
Yeah.
So, and then they also had some advice on where you can go to purchase homes for under $100,000 in the U.S., and then also, of course, the best places with sunshine all year round. So,
Got it. And just for our listeners, Mike and I are really, really young, so we're a ways off from retirement.
yes, ways.
Okay, not really young, but
Yeah, well, it's not happening anytime soon.
wishful
Let's
thankful.
hope.
Wishful thinking.
So that's what I got, Tina.
And I like on the 401k because I think it was sometime last year they required that they had to disclose all these fees in the 401k. So it was really time for us to look back and understand what our fees were that were all hidden and we could never see them before. So,
Right.
And then make sure when you're running your numbers that you're planning on inflation. I think most financial advisors, and Rich, you could correct me here later if I'm wrong, you really want to look at like a 3% inflation. And I'm going to talk about that in my money chat. And then I like to add in 11, Mike, because it's our arena and really just managing your mortgage and knowing what opportunities, just like any other investment, you should be talking to your mortgage professional on an annual basis to take a look at what's happening in your home, what you're planning on doing, where your needs are at. And there's a lot of things that you can be doing with your mortgage, especially if you've got some equity in the property. So if you haven't taken advantage of refinancing, you definitely want to look into that. So that was great for Money Chat, Mike.
Yeah, thank you.
Yeah. So I thought I would bring in inflation and how this might affect or how inflation does affect mortgage interest rates. So to kind of start out with this, I want to talk about quantitative easing. QE1 came out in December of 2008, ran through March of 2010. The Feds had announced that they would purchase $600 billion in mortgage-backed securities. March of 2009, the program would be expanded by an additional $750 billion in mortgage-backed securities and agency debt of $300 billion in purchased Treasury securities. So that was QE1. Then the Feds came out with QE2. November 2010, it ran through June of 2011. Fed announced that it would purchase another $600 billion in treasuries. So if you see where I'm going with this, with quantitative easing, the Feds are printing money, which is going to cause inflation. Then we had, after QE3, Operation Twist in September of 2011 purchased $400 billion in bonds. And then June in 2012, the Fed announced an extension of the Twist by adding an additional $267 billion. Then we roll into quantitative easing 3 in September of 2012. This new round was announced as an open-ended commitment to purchase 40 billion mortgage-backed securities per month. So if you heard me correctly say open-ended, continuing to do this until the labor market improves substantially. Now, we haven't really heard a lot about QE4, but there was a QE4 December 2012, continuing the $40 billion a month in purchasing mortgage-backed securities. And not only that, but now they've added $45 billion a month in long-term treasuries, totaling $85 billion every month until they see a significant recovery in employment. So the risk is with printing money that could possibly cause inflation. Inflation is when the cost of our goods and services, they cost more, which basically means our dollar is worth less. Higher inflation is bad for the mortgage bond. And if you know how interest rates work, mortgage interest rates are based on the bond market and how bonds are trading. So if the bond is not favoring or doing well, mortgage interest rates are not doing well either. So if you watch the Consumer Price Index, CPI, and the Producer Price Index, PPI, that's what measures inflation. CPI, Consumer Price Index, is the cost that consumers pay for goods that they pay at the store. And then your Producer Price Index is the cost wholesalers pay for their parts. So if PPI, the Producer Price Index, boy, that's a tongue twister.
It is.
PPI, Producer Price Index. Say that a few times. If that goes up, the wholesales prices are going to go up, meaning that they're going to make less, and obviously they're going to pass that on to the consumers, and the CPI, or the Consumer Price Index, is going to go up. So if you watch it, higher CPI and higher PPI means inflation. And again, inflation is bad for interest rates. So let's just bring this to a level as a listener. If you and I were getting ready to possibly lend a future homeowner money to buy a home, obviously we're going to look at the credit risk. So we're going to check their credit history, their debt-to-income ratio, decide if they can actually afford whatever that mortgage payment's going to be on what they want to borrow. Now, let's say for conversation purposes, that payment would be $1,500 a month for what you lended them. You're going to use that $1,500 a month to purchase goods and services on a monthly basis, your food, clothing, medicine, gas. On a bank level, they're using it to purchase their goods and services as well. So over time, you start to notice that inflation goes up, which means with that $1,500 a month, you're actually able to purchase less goods and services. So let's imagine that you are going to lend money to a new potential homeowner. You have to increase the interest rates. You have to increase the interest rates to accommodate for the fact that inflation has happened, and it's going to cost you more for those services, goods and services. So now, with the increase of interest rates, it might be $1,700 for that mortgage payment. And that's why, if you look at it from that level, that interest rates are going to increase because it's going to cost the banks more. So obviously, they're going to take that or increase in interest rates to accommodate for that. So if we take a look at the Feds and what their target for inflation is 1.2%. It's kind of what they would ideally like it to be. Budgeting, and Mike and I are not financial advisors, we're mortgage professionals, but most financial advisors, I think, use maybe a 3% inflation. If you want to look at what you need to save for future, as Mike was talking about retirement, if you want to just go ahead and budget that inflation's going to be 3% a year, that's probably a good number to use. So if we look at right now, December was released, it was 1.74. That was our inflation percentage. 2010 was when we hit our first historical low on interest rates. So if you remember back then, that's when we first hit under 4%. Now with 4% interest rate seems like a higher interest rate.
It does.
Because we've been in the under 4s for so long. But that was the first time historically that we ever hit under 4% interest rate. Inflation at that time was at 1.64%. Now, if we go back and look at 1979, inflation averaged at 11.22%, the highest since 1947. And when it was at 14.65%, 1979, mortgage interest rates hit 20%. So high inflation, high interest rates. So just a word of caution, if you're thinking about purchasing, Mike and I have said this many times in studio, it is always better to purchase at the lowest price. It is always better to purchase at the lowest cost. If you're thinking of cost versus price, a lower cost is always more important. It just happens to be that we're in the best of both worlds right now, where we have low price, low cost, and low price. So take advantage of where the interest rates are at right now. I don't have a crystal ball to say what interest rates are going to do in the future, but I have a hard time seeing that they can get much lower. And with all of the printing of the money that's going on right now, we could be at risk of inflation. Inflation causes higher interest rates. Coming up next on the Money Hour with Mitchell and Mercer, Hanna Haage with 8 Skies Mountain Capital. If you're thinking of getting into the investment market, you won't want to miss Hanna's structure investment products and her German engineering experience right here on 570 KVI after this short break.
Are you behind on your mortgage payments and unsure about the road ahead? Magnum Law Group helps families just like yours navigate through the foreclosure avoidance process. Are you underwater on your home and unsure what to do? Magnum Law Group will help you understand your options. Are you facing foreclosure and need to stop a trustee sale? Magnum Law Group has success in doing this and may be able to help you too. If you're tired of dealing with the banks and getting turned down for loan modification, Magnum Law Group will take on the banks for you and lead you through the process for the best possible outcome. They lead the competition with superior knowledge and expertise.
This is Craig from Magnum. You can reach us at 425-605-6393 or at www.magnumlawgroup.com. See you at the next seminar.
Ever wonder what the key element of a financially privileged life is? At 8 Sky Mountains Capital Management, they believe it's the absence of worry about money. To keep and make more of your hard-earned dollars, you need new sophisticated investment styles in the era of high-speed money. With revolutionary precision-engineered dynamic structures, you can protect your investments, fight inflation, profit from various market moves, lock in and even enhance your returns. 8 Sky Mountains Capital Management, the German engineering of finance. Visit them at esmcm.com.
This is the Money Hour with Mitchell and Mercer on Talk Radio 570 KBI. Now, back to the show with local mortgage and finance experts Tina Mitchell and Mike Mercer.
Welcome back to the Money Hour with Mitchell and Mercer here on 570 KBI every Sunday at 2 p.m. The purpose of our show is to help our listeners understand what's really going on in our local real estate market and financial arena. You can reach Tina and me at 1-888-987-0570 or contact us online at themoneyhour.com. Again, that's 1-888-987-0570 or online at themoneyhour.com. So, Tina, I'm excited about our guests that we have right now.
I am
in
too.
Studio. As I mentioned earlier, we have, of course, Rich Keal, who is a return guest. He's been on our show before, and as I mentioned, Rich is with Generational Wealth Advisors, which is a registered investment advisory firm. And Rich has been in the financial arena for well over 25 years. And I've personally known Rich for several years. So I'm excited to have him back. Welcome, Rich.
Thank you.
And we also have Hanna Haage, who has over 15 years experience in the investment and management industry. As a mathematician, investment analyst, and a portfolio manager, she has devoted her life to the quantitative world. She has designed, priced, and traded sophisticated derivative instruments, exotic options, and structured products at leading German banks, and has led several C++ programming projects through her financial consultation company in Berlin. Hanna has decided to bring her German engineering experience to the States and became the CEO and co-founder of 8 Sky Mountain Capital Management. And it's also a registered investment advisory firm. So, and with that, Hanna has created and brought a great investment paradigm shift to the U.S. So this is going to be very interesting. So, Hanna, welcome.
Thank you very much for having me.
Yeah. So I guess
And I love to listen to her accent.
I know, I love it.
Yeah.
And I hope I didn't murder the pronunciation of your last name.
I know I did, Hanna, and
Haage.
I'm sorry.
Yeah.
That's a hard one to say.
So, but to get things started, and we've had the pleasure of actually having you in our office and kicking back and having some of these discussions, which of course why we thought it'd be so great to get you in studio.
I love to listen to her talk about numbers.
Yeah, it's nuts, and especially when she starts drawing out those crazy diagrams and stuff.
Unfortunately, if you're listening, you can't actually see that.
Visual,
but yeah, it was pretty awesome.
But just work with us here on this.
I won't put in any formulas today.
Yeah, no writing formulas today. But so to get things started, what do you think investors would want if they could have it all?
This is exactly the question I've been asking from clients. And it's very interesting because after a few minutes, they all come up with the same answers. No or low risk, high returns, low fees, and high liquidity. And the problem is that traditional investments will never be able to meet all these criteria at once. There are products, on the other hand, so-called structured investment products, that come very close to meet all these requirements.
Yeah, Hanna, I want low risk, high returns, low fees, and liquidity too.
See, I knew that.
I absolutely want that. Get out a piece of paper and a pen. Write this number down, 1-888-987-0570. Again, that's 1-888-987-0570, or you can reach us online at themoneyhour.com. You will absolutely want to pick up the phone, give us a call so that we can connect you with Hanna. So, Hanna, tell us why in the States here most investors use the traditional investments.
Partly it is little known that structured investment products exist. The market here in the U.S. is very limited. Investments don't choose alternatives because they don't really have alternatives. It's not being offered to them. We are a little bit still in the transition phase here. It resembles to the process of sending messages in old times. First ever the messengers, next the Pony Express, then fax machines and so on, and now we have emails. And in each phase you can see that it's not a further development of the previous, but it's a completely new approach to sending messages. And that's exactly what we have with structured products. It's simply a new approach. But once investors understand the unique benefits of these products and how much more efficiently they can work for them, they will want to use them, and these products will become the mainstream investment choice. Limited risk and boundless adaptability is what make these products so appealing.
So, Rich, what was your opinion when you first met Hanna and you saw what she was doing? And I mean, you had to think this is too good to be true.
Well, excuse me, it was a little bit serendipitous because when I met Hanna at an association meeting about a year and a half ago, I had already been studying and using some variation of structured products, which were mostly issued by insurance companies. But meeting Hanna was pretty amazing for me because I finally met somebody who was at the source of their creation, which comes from Europe, and we just don't have a lot of the availability here in the United States, like Hanna said.
Well, even on the mortgage side, mortgage acceleration, which that's a whole other topic that we have, but
Precisely.
that started in Europe as well. I mean, the Europeans seem to be
progressive
and a little bit smarter with their money than we are on the United States, or maybe we're a little bit more skeptical. I don't know.
I have some theories on that.
Yeah, another show for that as well, right?
exactly.
Yeah,
Probably a whole show in itself.
Yeah, exactly. So I know that this obviously is a very different approach. And can you explain how an investor could compare this to his or her existing bond portfolios?
Well, let's break it down to two parts. Let's talk about risks. When investors decide on traditional asset classes for their portfolios, they are often presented with charts that go back 100 years, and it shows to the investors how stocks outperform cash in the long and the medium run. Yet it soon turns out that riding the equity market is not everybody's idea of fun. Many clients define themselves as moderate risk takers. The traditional industry created then the idea of diversification. This says that if you can diversify away specific risk that is associated with one underlying. By adding more and more stocks to your portfolio, you can diversify away the specific risk, reaching market risk. But that's the lowest you can go. You cannot go below market risk in your equity portfolio. You reach full diversification with approximately 30 stocks. Yet I often see mutual funds with hundreds or even thousands of stocks. And then many clients think, wow, that must be low risk. but now it's not. It's still market risk, and market risk is not the same as with the risk-free rate of return. So if you want to avoid market risk, but you still want to invest in the traditional ways, you need to choose, for instance, bonds. And with a high-quality bond or bond portfolio, you have a much lower risk. To be very accurate, I shall mention that the risk-free rate is a theoretical definition, and in the real world it doesn't exist because even the safest instruments carry a small amount of risk. But if you hold treasuries, especially short-term ones, you are as close as it gets to the risk-free rate. And structured investments combine the benefits of equity investments with bond investments. So in terms of risk, you have a risk that is similar to a bonds. Your initial capital is protected if you hold the investment to maturity, just like with bonds. The only difference is that instead of fixed coupons, you have variable coupons. And that means that you can not only have higher returns, but also lower, even zero. I mentioned diversification earlier. Again, diversification means to reach the market risk. Since your principal is protected with a structured product and it can be invested into elements that have the risk-free rate of return, or better to say a rate that is very close to that, with these products you have neither the specific nor the market risk. Let's move on and talk about returns.
Returns is good, Hanna.
Yeah, everybody loves them. Stocks provide return through dividend incomes and growth. But if the market is flat, you just have the dividend income. If the market is bearish, your negative returns may be so bad that the dividends do not offset for these losses. With bonds, you have a steady income in forms of coupons. However, the return is very small, especially these days. So as I said earlier, structured investments combine the benefits of equity investments with bond investments. So in terms of return, you can, in some ways, compare structured products to stocks, because with these products you have access to the stock market. The revolutionary factor is that you can not only extract positive moves to your advantage, but also negative ones. And you can even generate returns from the lack of moves. You can also apply factors and extract these moves multiple times. So, and with structured products, you don't have the risk of a fund manager's underperformance. It can also not happen that although you outperform the market, you are still in minus because the whole market crashed. With structured investment products, your worst return is zero. It's never negative. And one more important...
Wait, say that one more time. It's never...
Negative.
It's never
it's
negative.
Never negative. That's correct.
I'm just saying. That's amazing. Brilliant, yes.
And maybe just one more important thing, that how the equities perform in the structured product and what kind of payoff they give you has not much to do with diversification, but rather with optimization.
Wow. That's a lot of in the information, and again, a call to action, because you really can't put your arms around all this or grasp it until you're able to sit down and really go through this with you, Hanna. Definitely give us a call at 1-888-987-0570. Again, 1-888-987-0570, so we can get you in contact with Hanna. But so kind of in recapping, Hanna, I got two questions for you. First, I want to find out, what are structured investment products and how do they really give investors what they really want? And then after you're done talking about that, I want to ask you real quickly about my discussion topic earlier about retirement and what your opinion was of that. But go ahead.
Yeah, so earlier I mentioned that investors want low risk, high returns,
Yep.
low fees, and high liquidity. So let's go through quickly all these points. We can truly say that structured investment products have rewritten the rulebook for investors regarding to risk. Given that risk is the single big factor that can concern or even stop prospective investors from making stock market decisions, defining and potentially removing it is a major advantage. Structured products give you a high level of security by limiting your downside risk. This is because embedded in them, there is usually a zero bond or a low coupon bond, and this bond protects part or all of the invested capital. For us at Sky Mountains, the standard is 100% protection, and we make only lower levels if the client is explicitly asking for it. The second and equally exceptional factor is that structured investments provide the potential to earn higher returns than bonds or deposits. It's because they have other embedded components in them that make it possible for the investor to have payoffs that are linked to the performance of commodities, stocks, currencies, interest rates, indices, or even other assets. Furthermore, it is unique that the payoffs are precisely defined and the potential returns are known for the investor before he commits to the investment. Accurate foresight is, of course, unheard of when it comes to investing, but this is as close as it gets. And the payoffs can take form of either regular coupons or one-time payment at maturity. And the embedded components are usually simple options, or as we call them, plain vanilla ones, or ideally exotic or even mountain range ones. And maybe we can come back later to this point because it's very fascinating. With mountain range options, precise strategies can be developed and tailor-made to the investor's needs. Certain expectations can be addressed, turned into returns, and these returns can even be enhanced. So structured products are low risk. They offer the potential for high returns. They are also very liquid, and it's also fair to say that their cost is just a fraction than those of mutual funds.
So, Hanna, we might have someone listening today and asking the question, who should be considering these structured assets, and what questions should they be asking before making the decision to move forward?
Yeah, structured products are suitable for deposit or bond investors who are willing to forfeit the fixed steady income for potentially higher returns, but they are not willing to risk their capital. For investors who want to increase the defensive part of their portfolios, for those who are looking for investments that perform differently, and for those who would like to bet on downward moves without exposing themselves to the high risk involved in short selling. Actually, they are really good for pension products. And if the structure is using mountain range options, it's suitable for growth investors who would like to enhance the return of a segment of their portfolio without adding risk to their investments, for investors who would like to participate in international markets without the currency risk, or for those who would like to lock in certain performance levels for the future or carry forward a fraction of a positive performance to future years, or would like to catch up in good years for all the missed performances of the previous years. It's really fascinating, isn't it?
Well, there's nobody out there that would fit.
So
nobody's lost money in the past.
So in order to decide how exactly your product shall be structured, you need to clarify some details. You need to ask yourself, what is my time frame? What markets do I want to participate in? Am I willing to forfeit bond returns in hope of earning returns from the underlying basket? What kind of issuer risk am I willing to take on? What type of market moves do I expect? Bullish, bearish, or sideways? What type of features of the product would enhance the payoff on my bet? Would I like to earn returns periodically or only at maturity? Will I be buying the structured products as a buy and hold strategy, or will those be actively managed? Am I expecting inflation or even hyperinflation? Yes, so those would be the most necessary questions you would need to ask.
So lots of options, depending on what your strategy and what your needs are.
Yeah. Yep. And then, just thinking about this, how big is the structured product market right now?
Oh, it's very much depending on the geography.
What about Seattle? The greater Seattle area. What have you seen that you?
It's not the number one. I'm sorry. No, in Germany, it feels like issuers lay out certificates like on an assembly line. It's even the National Post Office is offering such products. Wow. On the two derivatives exchanges, OIVAX and Scotch.de, currently there are more than, 1 million listed products. There are 20,000 new offerings alone in January. And the traded volume in 2012 was about 100 billion euro, and 2/3 of these were products with capital guarantee. But let's have a look at other markets. In Switzerland, you can currently trade 40,000 products. In Austria, 6,000. In Spain, 4,700. On the NDX, Nordic Derivatives Exchange, over 4,500. In Italy, 4,300. And in Hong Kong, about 4,000 products. In comparison, the US market is very modest and completely lacks sophisticated structures. After hearing these large numbers from Europe, you'll be shocked because here are less than 70 products, and that's already including 7 new offerings. Yeah, it's pretty amazing. So over 1 million in Germany and less than 70 in the US, and that's a huge difference. I think the main reason is that structuring is a very time-consuming process. It's not for the investor time-consuming, but for the issuing banks.
Yeah.
It's very tedious to come up with truly good products. So U.S. banks have the same structures, and they issue them over and over again, adjusting just the market rates or changing the underlyings. So somehow it feels like we have like a fast food finance in America.
Yeah.
It's like a restaurant where only the table turnover rate matters, and you hardly had your main course. The waiter or waitress ask you if you'd like a dessert or if they can bring you the bill. And if you are in France, you can pretty much spend the whole day in a cafe with a single cup of coffee and without the guilt that you should be moving on because you are no longer desired.
That's excellent.
We at 8 Sky Mountains have invested 6 years to develop a structuring and pricing tool that can design and price over 200,000 different mountain range options.
Wow,
That's amazing.
Hannah, it was so awesome to
Yeah.
have you in studio. Thank you so much for sharing your wealth of information.
Thank you for having me.
Yeah, we'll have to have the listeners pick up the phone. Give us a call, 1-888-987-0570. We'll get you hooked up with Hannah.
And Rich, thanks for coming
Yeah,
in
Rich,
as well.
thanks for coming
Thank
back.
you.
And
No
we
time to talk for you, but thanks for coming back.
Yeah.
Next time.
And
I'm
I'm-
just glad we got to bring her in.
Yeah, I'm sure our listeners want to know why this stuff is not being offered
Yes.
more here. So we'll,
We'll catch that next.
Okay.
Coming up next on the Money Hour with Mitchell and Mercer, you won't want to miss Angela Hardy with Prudential Northwest Real Estate, here to discuss the importance of knowing your market and your property when writing and reviewing an offer, right here on 570 KVI after this short break.
Looking for a real estate agent you can trust? One that will guide you through home buying or selling in today's changing market? Angela Hardy with Prudential Northwest Realty received the Seattle Magazine 5-Star Best in Client Service Award for 4 years running and takes pride in providing outstanding service to her clients.
This is Angela Hardy with Prudential Northwest Realty. I focus on every client, every home, every day. You can reach me at everydayagent.com or at 425-210-1071. 425-210-1071.
This is the Money Hour with Mitchell and Mercer on Talk Radio 570 KBI. Now, back to the show with local mortgage and finance experts Tina Mitchell and Mike Mercer.
Welcome back to the Money Hour with Mitchell and Mercer here on 570 KVI every Sunday at 2 p.m. The purpose of our show is to help our listeners understand what's really going on in our local real estate market and financial arena. You can reach Tina and me at 1-888-987-0570 or contact us online at themoneyhour.com. Again, that's 1-888-987-0570 or online at themoneyhour.com. So, Tina, we have Angela Hardy from Prudential Northwest Realty in studio. And, Angela has been a top producing residential real estate agent for quite a long time. She has received the Seattle Magazine 5-Star Best in Client Service Award for the last 4 years running, and has also earned the Accredited Staging Professional and Certified Foreclosure Specialist designations. Oh, that's a mouthful.
That's a mouthful.
Angela's background includes a BA in marketing from the University of Puget Sound, and she also holds a managing broker's real estate license for the state of Washington. She is dedicated. She is a dedicated hockey mom. I bet you're hoping that the NHL, we get a professional team here.
That would be
Yes.
very exciting, yes.
And she's a very tough negotiator. So clients
Boy, in this
definitely
market, you
yes.
absolutely need to have a tough negotiator, that's for sure.
So, but so Angela, I guess our first question would be, and I know that you wanted to kind of specifically talk about the importance of knowing your market and the property when you're when you're going to write an offer or you're receiving an offer. So I guess my first question would be, why is knowing the current market important to a buyer or a seller today? What's so important about that right now?
Well, how you write or evaluate an offer in a market really varies with the market conditions. For example, if you're structuring an offer in a market with limited inventory, like we have right now.
Right now, yep.
It is different than how you structure a deal in a market with an abundance of available properties. Pricing is, of course, one of the biggest factors that's affected by inventory, right? Basic supply and demand. For homes sold in the last 30 days in Snohomish County, the average sales price to the list price was 99.42%.
Wow.
In King County, it's 99.71%. So really, homes are selling for very close to the listed price.
Right.
Not the kind of market that you're going to probably be successful with a lowball offer.
And we still see our agents calling us and telling us that their clients are getting ready to write an offer for $10,000 under the purchase price or the list price, and they know the agent basically knows that they're writing an offer that's never going to be looked. I mean, it's kind of a waste of time. But you kind of
they're
have
just going through the exercise because the client wants to do it.
They're
You've
going through the motions, right?
Yeah,
which is unfortunate that they're not listening to the representation. That's why you hire a realtor, is to listen to what they're suggesting that you need to do, and especially in this environment. I always just tell my clients, I just don't want you to come back with black and blue eyes. You got to be prepared to go in there and fight and listen to what Angela is telling you, because she knows exactly what's happening in the market.
Right, and sometimes people lose a few homes.
Then they get it.
They understand the market.
Yeah.
But that's really why you go and you find a professional who knows the market, is to give you that good advice and help you get the home that you really want.
Right.
So, Angela, how does a buyer or seller find out about the current trends in the real estate? Because there's so much information online, and it's really finding the best sources to get the information that you want. What would be some tips from you?
Absolutely. Well, the biggest thing to remember is that real estate is hyper local. So a lot of times when you hear in the media and they're talking about Washington State, it doesn't necessarily relate to what's happening in your neighborhood. What's happening in Marysville is way different than what's happening in Everett. And sometimes it's even as different as Ballard versus Green Lake. Yeah. So what they need to do is find an agent who's active in the market they're focusing on. Active agents have a good feel for the current conditions, and they'll be able to talk confidently with you about what they're seeing happen with offers, the current inventory, and trends in new construction and foreclosures in the area, which both significantly affect what's happening for offers.
Right. And before, I know that probably the media plays into a lot of that, but I wanted to just reverse back a little bit. Earlier in the studio, we were talking, you had talked about like other ways that you could structure an offer that's appropriate to the market. Can you touch a little bit on that?
Sure. Besides price, there's a lot of things that influence whether or not your offer can be accepted on a property. One of those is the inspection period. So you can be more aggressive and shorten your inspection period. I never recommend that anyone waive an inspection. I think that's way too risky.
And what about going in and doing the inspection prior to, so paying for it before they make their offer so that they can waive it?
Yep, you can do a pre-inspection. That's another good option. The other things to think about are your financing period, doing a lot of work ahead of time with your mortgage broker so that you can shorten up that financing period and feel good about it. And kind of avoiding any unusual requests. Like, we want you to leave the entire set of patio furniture, or, we really want that piece of custom art that's hanging above the fireplace. Because if they're reviewing 2 or 3 or 4 offers, and the other folks aren't asking for those things, it puts you at a disadvantage.
Every little thing can be a really big thing.
Absolutely.
What about the escalation clauses?
It depends on the type of property you're purchasing. Bank-owned and short sales don't even allow an escalation clause in the contract.
Okay.
But if you're working with a regular seller, that's definitely something that you could put into the contract to help make your offer the best.
Okay. So if you're listening, if you're buying directly from a seller, basically escalation clauses where you're going to go in, if you want to make an offer at $300,000 and that's what you want to pay for the seller, but there's multiple offers, you can say that you're willing to pay up to, increments of $1,000 up to a maximum of $5,000, whatever that would be. But you have to be proven, you have to show that there is another buyer that came in that offered more than your $300,000. So outside of that, Angela, what other suggestions do you have for potential buyers that are looking at distressed properties? Because there's so many of them. So we're talking about bank-owned properties, short sales, any of those distressed options.
Sure. One of the things to think about are HUD properties, because HUD properties can be a great deal for the buyer. You, of course, have to work with a registered HUD agent and able to bid on a HUD home. And there's a couple nuances with the HUD properties. The most important thing to understand is that they are listed at the FHA appraised price. So an FHA appraisal has already been completed, and that is the price on the home. Now, HUD has one special rule on their FHA appraisal. That is only above grade square footage counts on the appraisal. So if you can find like a daylight basement home, you'll get a fantastic deal because all that
Boy,
underground,
that's a good tip.
that
Wow.
underground square footage isn't on the appraisal. So you can get a really great deal on that. The other thing to remember is if you're using an FHA loan and you're buying a HUD property, if you bid over the list price, so you feel like the house is undervalued for whatever reason, or there's multiple offers and you want to bid above, you have to pay that difference in cash.
Good
Whether
point.
it's $1 or $10,000 over, you must pay it in cash because they've already had the FHA appraisal.
So on these HUD properties, you're never really getting the seller or the bank to pay towards closing costs. It's not a typical situation where you can kind of roll it in because you're not going to get them to negotiate the price down, and therefore because the appraisal's already been done, the price has already been set, you can't really increase it. So that you really have to be prepared to have your closing costs in cash, right?
Typically, the other way around that is to use a conventional loan, because when you use the conventional loan, you get a whole new appraisal.
Gotcha. Okay.
So if you feel for whatever reason that the home was undervalued at the FHA appraisal, maybe they didn't include all the square footage, for example, you can use a conventional loan, bid up the price, ask for closing costs, however you want to structure your offer.
Yep.
And then get a whole brand new appraisal.
You just need to make sure, because sometimes with those HUD properties, they're in bad condition because they were taken away from the current owners. So you've got to make sure that it's going to pass the appraisal with a conventional loan. And my advice on the financing side, if you are looking at purchasing one of these HUD homes, and Angela and I know that you'd absolutely second this, you have to work with a lender that knows what they're doing. The financing is very, very complex on these HUD home loans, and so you have to work with somebody that understands and knows what they're doing. So if you're thinking of buying distressed property, pick up the phone, give us a call, 1-888-987-0570. Again, 1-888-987-0570, and we'll connect you with Angela. So Angela, how about the bank-owned or regular resale homes?
Sure. The difference on a bank-owned, one of the big differences is that we go into it knowing that it's as is. The seller's going to do no work. The bank just wants to sell the house. The utilities will probably be turned off and probably won't get turned on for your inspection unless the buyer pays a fee to do so, because the bank's done. They're not.
And that's a
gonna
good
invest any more
point to
money.
mention, because they got to be turned on for the appraisal. So,
Yes.
I mean, there's some complications that can come up during that process.
And then the big one is that when you buy a resale home, they have to fill out what's called a Form 17, a seller's disclosure. It tells you anything that they've done to the house, any remodeling, any repairs, has the roof leaked, those kinds of questions, that kind of information. The bank doesn't fill that form out because the bank has never lived in the house and doesn't have that information.
Yeah.
So you don't get prior history on the property. And that can be a big deal. So you don't know, is the roof 2 years old or is the roof 12 years old? And of course, you'll get to do your inspection, but those Form 17s really provide a lot of good information. And then the other factor is kind of the people factor. Buyers are emotional when they're buying a house. There's just no way around it. A buyer is making it a big purchase and they're emotionally attached to it. A seller, a regular seller, is also emotionally attached to the house that they're selling.
Yeah.
They've done work in the house. They raised their children there.
Yeah.
They need to get a certain amount of money out to realize the dreams that they have for their next property or for retirement. So there's emotions on both sides. When you're dealing with a bank, it's just all about the numbers.
Yep.
They, and I can write you a really nice sappy letter if you're my buyer about how you want to raise your children and this is going to be your forever home and you just love all the gardening they did in the backyard. The bank is not going to care. They're not even going to read that letter. But it can help us win a home on a resale, maybe even if we're not the best price.
Yeah, absolutely. And I've heard that many, many times. Had buyers experience that, to where they got an excellent deal on a home when there was multiple offers because of that letter. And you think about it and you're like, that can't be. You can't, very rarely would that ever happen. I've seen it happen a lot because of the emotional seller.
Yeah, what are you suggesting right now to clients that are wanting to make offers on short sales? I know that they can be anywhere right from 3 to 6 months right now.
Yeah, the biggest thing about a short sale is bring your patience, because they can take 3 to 6 months.
Longer if they have more than one lien.
Exactly,
Those
and
are a
depending on the
nightmare.
bank, some banks are just known to take longer. With our limited inventory, short sales need to be a consideration for a lot of buyers because they just don't have as many options. And what's hard about a short sale is that the bank that holds the lien will not give any indication of what price they're willing to take until they have an offer in hand.
Yep.
So the listing agent does their best job to figure out a market value and list the home at that price. But I have seen time and time again, it's listed for $250. You write an offer for $250. It goes to the bank. 2 months later, the bank comes back and says, we want $300.
Yeah.
And that may be more than your buyer can afford to pay. So there's some nuances with those short sales. What you really want to do is study the comparable sales when you're writing your offer so you can feel confident that the price is within a range that the bank will be willing to accept.
And are you still encouraging your buyers to be making other offers during that time and not freeze up?
There's two ways to write the short sale addendum. And one is that the buyer may walk anytime before bank approval with no penalty. And the other is may not walk. So as a buyer's agent, I'm always writing the contract as may.
Yep.
And we keep looking. And if something else comes up that they can close on quickly and not wait for a short sale, and we get it under contract, then we just cancel our short sale and move on.
So why would anybody check the may not?
Yeah, does it make their offer stronger?
There are some banks or some third-party negotiators that require the buyer to stay committed.
Okay.
And then the way we combat that is the paragraph above tells how many days you give the bank to respond. And so instead of putting 6 months, we'll put you can have 90 days or you can have 60 days.
Got it. And the other thing to be cautious of is as well on short sale when it comes to the financing is the banks are not only are they not emotional, but because of that, they really don't care. They don't care if this thing goes through or not. And it's just people that are just pushing it through. If it doesn't work, it doesn't work. They move on to the next one. And where that issue comes in is with the closing date. You have to really have your lender be in a position that they can move forward really quickly because that once the offer gets accepted, that closing date comes up and it's never a standard 30-day closing. And the challenge is it used to be that you can actually order the appraisal ahead of time. That's what we used to do way back when all these distressed properties started. But you had mentioned it, Angela. You cannot do that anymore because many, many times the price gets changed. So you can't order the appraisal to get that process out of the way. And then the price changes. Then you've got a whole nother issue to deal with. So it's a timing thing that can be a challenge as well.
Yep. And that's what I always tell my clients is you have to be patient. Short sale means short on money, not short on time.
That's a good one.
I like that.
And but when we get the approval, if we get an approval on the short sale, then it's hurry up, hurry up, hurry up.
Yep.
Because the bank, although they made us wait, they're not going to wait for us, and we got to be really ready to roll.
Yeah, really frustrating process sometimes. So we've talked a lot about buyers. What about market conditions, education for sellers?
Sure. When a seller's reviewing an offer, they also need to really be thinking about that appraisal issue. It's exciting when your home gets a ton of offers and the price gets bid up and you want to go with the highest price. But if the home ends up ultimately not appraising for that high price, you're kind of back to square one. And then it's extra frustrating because a lot of buyers have moved on to other properties. So the sellers, when they're reviewing the offers, also really need to look at those comparable sales and make sure that they feel comfortable, but the home is going to appraise for whatever price their home ended up getting offers at.
Right. And the highest offer doesn't necessarily equate to the best qualified buyer.
Exactly. Buyers get emotional too, and sometimes they bid up a price above where they really should to be qualified. But the other things to think about for a seller is the type of financing that the buyers are using. Cash is good because there's no appraisal and you don't have to worry about financing failing at the last minute. FHA and VA have some condition requirements for the property. So you want to talk with your agent and make sure you're comfortable that you're not going to have like a roof issue. Even missing flooring can be a problem on an FHA appraisal.
Yep.
So you want to be prepared for those kinds of things if you choose an FHA or a VA loan. And then you want to look at how much your buyer's putting down on the loan so you can compare buyer to buyer. If one buyer's putting down 20% and one buyer's putting down 5%, it's, kind of assumed that the 20% buyer is a little more qualified.
So I got to ask you, Angela, what are your predictions? Best guess crystal ball that you have on the trends that are happening in our market here, local market in the Northwest, what you see happening this year in real estate.
What I'm seeing so far, obviously, is low inventory, right? Because sellers are scared. They've heard for 2 years that prices are down, prices are down, prices are down, you can't sell.
Yep.
We've cleared out a lot of the distressed inventory because of the low interest rates. Buyers still want to buy. So with continued low interest rates, I think it's a great time for sellers. I'm seeing a pickup in relocation, people moving into the area for work.
Okay.
Businesses starting to transfer more people in.
Yeah.
So that adds buyer pressure. So I don't expect the huge doubling of the value of your home in only 6 months kind of stuff that we saw. But I expect some continued steady growth. And as sellers realize that maybe it's a good time for them, they can sell their home and still take advantage of a low interest rate to buy up. We'll see a little more inventory come on. So I'm really expecting just kind of a stable, slowly increasing prices. And I do expect the interest rates to stay reasonable for folks.
Well, that's it, Angela. We are out of time. Thank you so much for coming in and joining Mike and I in studio and sharing your information with our listeners.
Thank you.
Thanks, Angela. Thanks for coming. So this is Mike Mercer signing off for the Mortgage Diva, Miss Tina Mitchell.
And this is Tina Mitchell signing off for the Mortgage Master, Mike Mercer. Thank you, everyone, for joining us this Sunday in studio. We look forward to talking with you next Sunday, same time, same place.
Thanks, guys. Have a great week.
Ever wonder what the key element of a financially privileged life is? At 8 Sky Mountains Capital Management, they believe it's the absence of worry about money. To keep and make more of your hard-earned dollars, you need new sophisticated investment styles in the era of high-speed money. With revolutionary precision-engineered dynamic structures, you can protect your investments, fight inflation, profit from various market moves, lock in and even enhance your returns. 8 Sky Mountains Capital Management, the German engineering of finance. Visit them at esmcm.com.
Looking for a real estate agent you can trust? One that will guide you through home buying or selling in today's changing market? Angela Hardy with Prudential Northwest Realty received the Seattle Magazine 5-star Best in Client Service Award for 4 years running and takes pride in providing outstanding service to her clients.
This is Angela Hardy with Prudential Northwest Realty. I focus on every client, every home, every day. You can reach me at everydayagent.com or at 425-210-1071. 425-210-1071.